Welcome, everyone. We're so glad you can join us for this on-demand webinar hosted by JFL Total Wealth Management. Today's session is part of a multi-part series called Laying Your Financial Foundation, where we review the important fundamentals for saving and spending when you're in your 20s and 30s and demonstrate how your financial success will depend on more than just a good income. Today, we were reviewing how much car you can afford, as well as the pros and cons of a lease versus buying. While each of your financial situations are unique, there are certain foundations, including budgeting responsibly for car expenses, you all need in order to start the path to financial success. If you have any questions at the end of the presentation, please contact our office. We highly recommend checking out our webinar library at jfltotalwealth.net/webinars for additional installments of our Laying Your Financial Foundation series. We review budgeting, saving for retirement, managing student loans and other debt, insurance protection, and how much you can expect to pay for big expenses like your first house. You can also download copies of these presentations on our website. Without further ado, let's introduce today's speaker. Jerry Lynch is a certified financial planner and has been an independent financial advisor for 23 years, working in the financial industry for more than 30. He has 3 sons, one already in college, one headed there in the fall, and another in high school.
Hello, everybody. Welcome.
We know that each of you have a personal view of what success might look like for you as you get older, have families of your own, and reach career milestones. Our goal during this series is to provide you with the background with the topics listed here today, so you have the foundations for financial security at every stage of your life. Today, we are talking about budgeting responsibly for your auto needs. Jerry, take it away.
Thanks, Gretchen. Again, we're going to talk a little bit about cars today and really what makes sense from a financial standpoint of what we should be buying and how do we go about the process. I think it's very important to understand just some of the numbers that you should be thinking about when you go out and you buy a car for the first time. So the first thing is the 15% rule. So you should not be paying more than 15% of your after-tax income in car payments, and that includes a couple of different things. You also need to take into consideration how much it costs to maintain that car. You have car insurance that is required in many states to do this. You have payments for maintenance, you have payments for gas, you have a bunch of other things that are responsible for it. We also had a webinar that talked about this thing a little bit more. You may want to spend some time on that, but let's just assume for argument's sake, you're taking home $50,000 a year. The most you should be putting on your car should be about $7,500 per year. Now, as your income increases, you shouldn't be increasing that 15%, meaning if you make $1 million, you shouldn't be spending $150,000 a year on a car. I think that kind of makes sense. But again, at least initially, this number makes a pretty good place to start. The second thing is that you have to understand is you're buying a depreciating asset. The minute you drive that car off the lot, it's worth about 20% less. And as a general rule, I don't like to spending a lot of money on depreciating assets. After 5 years, it'll be worth about 40% of what you first paid for it. So again, you're buying something over a period of time that is going to go down in value, guaranteed. So we want to make sure that we're buying something that's reasonable, that we're sure we're going to be able to hold on to for a period of time, because you want to limit how often you're buying depreciating assets. What I historically do is I buy certified pre-owned cars. I think that there's tremendous value in buying something that somebody's driven for 1 or 2 years. I buy it at that period of time. I get it at a very nice discount. And generally what I'll do is I'll drive these cars into the ground. Many of these have warranties on them, so that if there's something wrong with the car over a period of time, that they're guaranteed to fix it at no cost to me as well too. But again, my goal when I'm going out and buying a car is I want to buy something reasonable. I want to make something that is going to work with me for a period of time based on my lifestyle. And I want to make sure I maintain a consistent cost of what I want to do over the period of time. If you are going to have changes in your life, you need to take that into consideration. So for example, you don't want to buy a 2-seater Miata if you think you're going to be starting a family and having children. It's just not going to work. You want to make sure that the car will last you for a period of time and that we don't have to go out on a regular basis and buy depreciating assets. Now, often people ask me, does it make more sense for me to lease or does it make more sense for me to buy? And again, it really depends on the specifics of your situation. So the advantage of leasing a car is that, first of all, your payments are generally lower. They could get into a lease at a very reasonable price and you'll maintain it for a period of time. Every couple of years, you'll have a brand new car. So for the most part, you'll have tremendous technology in that car. I mean, in terms of Bluetooth and everything like that, most of the newer cars have all the bells and whistles and will continue. If you're getting a new one every 2 to 3 years, will have all those things. And as your life changes, you have the ability to get in and out of a car very, very quickly. Now, the disadvantage of these types of programs is that a couple of things. Number one is you got to maintain a certain level of driving, meaning that you'll buy a package that has 7,500 miles a year, 10,000 miles a year, 15,000 miles a year. If you go over that, you're going to be hit with some pretty serious charges on the back end when you give your car back. So you need to make sure you're buying something that is reasonable in terms of the miles that you're giving him. When you bring the car back, they're going to say you need to replace your tires. If there's damage to the car, you'll be required to fix that and give the dealer a check when you're bringing the car back. And if you have bad credit, it may be difficult to get yourself into a lease. The credit requirements are a little bit higher on a lease than it is when you're buying and you have some money that you're putting down as a down payment. Now, the advantage of buying a car is simply that you have equity. At some point in the future, you actually have an asset that's worth something after you pay it off. There's no payments once the car payments are finished. So the nice thing there is, let's just assume our car payment was $400 a month. Once I stop paying that $400 a month, I immediately shift that payment into my investment account. So I maintain my cash flow is exactly the same, and I just redirect those dollars from going to the auto company to my investment account. Over a period of time, I'm building some equity, which is what I want to do. And the financing is generally easier on buying than it is on leasing because you're putting a certain portion of your money down. So there's less risk to the finance company when you're doing that. Again, the downside of buying is that it's more expensive short term. Generally, the car payments that you have when you're buying a car are going to be more expensive than when you're leasing. You're paying interest on the entire cost of the car. Now, sometimes, like right now, interest rates are very reasonable, but you are paying interest on the entire cost of the car. And at some point, the warranty is going to end, and you're going to need to make sure that if there's a major servicing issue that you have, and you have the money set aside to take care of it. And generally, that's not going to happen on a lease, on a 2-year lease, because that's usually will be covered under the warranty period. But as long as you maintain your car and you generally change the oil, change the tires, rotate them, everything like that, cars can last a very long time. So right now, my current car has 130,000 miles on it. My old car, who I gave to my son, has 220,000 miles on it. Now, the advantage for me in this situation is that I haven't had a car payment in quite some time. The money that I would be paying in car payments, I get to invest in my account once a month. Over a period of time, when I want to go out and buy a car, I'll have the ability to buy cash because I've been investing that money on a systematic basis. Again, it really comes down to really what works for you, but I'm a fan of buying what works at the lowest possible cost. Some of the best practices when you're going to buy a car, number one, is that your car payment should be around 15% of your take-home pay. That includes gas, it includes maintenance. Again, if you're in a place that you need parking, take that into consideration. You don't want to have a really nice car that you can't drive because you don't have any money for gas. What do you need short-term and long-term? Again, more important when I'm looking at these things, I'm always saying, well, I need this type of car in the next 3 to 5 years. Sports cars are fun, I totally get it. However, they're not practical in certain types of situations. If you're in an area that snows a lot or whatever, you probably need more of a vehicle that has 4-wheel drive. So take into consideration not just what you want, but really what makes sense over the next couple of years, because if you buy a car and you get out of it, it's going to be a very expensive process. And not all the cars and the maintenance are the same. Get a Consumer Reports magazine and check out how reliable these cars are. I mean, again, I mentioned to you before, I have quite a few miles in my car. I buy cars that will last a very long time. I maintain the heck out of them. I make sure that I'm doing everything that I'm supposed to be doing so that car will run for a very long period of time. And because of that, I save a tremendous amount of money. Okay, if you need a car that is very expensive to maintain, especially after it's out of the warranty period, and usually those are a lot of the luxury cars, it can be tremendously expensive if you have a serious repair. So just getting back into really what do we want to be doing in terms of in our overall financial planning practice is live beneath your means. You know, many of the people who I know that are very financially successful are not driving expensive cars. They're driving reasonable cars. They get over it over a period of time. You don't need a Rolls Royce to basically be successful in life. You're successful in life by having a big bank account. Number two, do not take every raise that you have and go out and spend that money. If you get a $5,000, $10,000 raise, take half of it. and use it for fun. And the other half, invest that on a systematic basis. The way that you become successfully financial is not by your income, it's by your assets. Okay, so we need to make sure that we're setting aside money on a systematic basis. And as our income increases, we should be saving more and more money. Automate the process. I don't write a check for anything. Once the month money automatically comes out of my bank account, goes into my investment account, it automatically gets invested into the funds that I want to do. Everything I have is automated. Every once in a while, I take a step back and I just see how is the system working. And I want to make sure that everything is going. Can I invest more on a regular basis? But once I decide what it is I want to do, I don't think about it. I automate the system. As you start getting more and more stuff, take a look at your estate planning documents. You need to make sure that they're in line with what the assets are that you have in your family. And finally, especially if you're younger, you're probably in some of the lowest tax brackets of your life. Take advantage of that. Consider doing Roth 401ks or Roth IRAs right now, because that's the most powerful money that you're ever going to invest. And the extent that you could do that income tax free today, that money is going to grow for the next 40, 50 years tax-free, and at some point in the future, you're going to be incredibly happy that you did that. I just think as you go through this and you take a look at cars, it's important to understand, again, what I said when I started, is you're buying a depreciating asset. All right. Everybody has something that they spend more money than they should on. Some people golf, some people play tennis, some people travel a lot, and some people like cars. And if that's it, I totally understand and get it. But to the extent that you could minimize whatever cost you have with that, and you could redirect some of the money that you have into investment accounts over a period of time, you're going to be very happy that you did. I want to thank everybody for your time today. And if you have any questions, please feel free to reach out and give us a call. Gretchen?
Thanks, Jerry, for that great advice on determining what kind of car you can afford. If you have any questions, as Jerry said, or want to speak with Jerry about your personal financial situation, please contact our office. And be sure to visit our website where you can view other key financial topics that were mentioned during this presentation, such as protecting yourself with the right car insurance. Thanks, everyone.